This is Planning for the Future, the podcast, with our guest, John Jenkins.
So when it comes to long-term care, the biggest thing is the planning, right?
Absolutely.
Is there ever a good time to start planning? Should you wait, or is it's never too early to start, right?
Well, I laugh about that, Brendan, because the time to start is before the diagnosis. So if ever the P word, Parkinson, or C word, cancer, or A word, Alzheimer's shows up in your medical record, you can pretty much write off getting long-term care coverage. I like to tell our clients that both insurance and loans are things that you should apply for when you don't need them, because you can't get them when you need them.
Even when you see these ads saying, even if you already have, these things, we can get you on this life insurance policy, but it's really not going to cover everything that you would expect.
No, it typically will either have some kind of an exclusion. So if you can get the coverage with a pre-existing condition, an insurance company might offer that, but they might exclude that specific condition and cover you for everything else. That still has tremendous value depending upon the health history in your family. We've had a number of clients do that kind of coverage, but they know they're being excluded on probably one primary cause. The other thing is to do the planning so that insurance is much less needed at the time that it might occur.
When somebody comes in to plan for the first time, obviously what might be good for them initially as a client can change. So even if they come in and start with you tomorrow, and 2 years from now their life changes, they can adjust what they're doing, right?
Yes, absolutely. In fact, flexibility, in my view, is the key ingredient in financial planning because, as you said, things change. I like to tell our clients that the investment environment will change, tax laws will change, their personal circumstances, family circumstances will change. So change is the one constant in our industry. It's actually why I love it, because I would make the world's worst conveyor belt worker. I love the creativity needed to work on each individual family and their situation and their goals and their objectives. So change is an important component of planning, and we have to be ready to roll with those punches, so to speak, and change as the family's needs change.
And you brought up a really good point there too, is everybody's unique. So it's not a cookie cutter situation. It's not like something you can go on the internet and say, okay, well, I signed up for long-term care.
Right.
That's why somebody would come to see you, because you can look at each individual situation and try to put together something that makes sense.
Sure.
Because what makes sense for me might not make sense for you, right?
Absolutely. In fact, the way I explain it to clients is that I'm not interested in them becoming insurance rich and cash poor. None of us want to be that. So what we look at is what we call a cash needs analysis. In other words, if I'm suddenly institutionalized and I'm retired, all my forms of income are still coming in. I'm still taking my required minimum distribution out of an IRA. I'm still getting my Social Security. Perhaps there's a pension. All of that is still coming in along with dividends or interest where those apply. So if I'm now institutionalized and not running around town spending money, driving, going on trips, etc., then some of the costs at home go down. Some of them don't. The well spouse is still residing in the home, so there's still the home cost, but we no longer need 2 cars. We're no longer feeding 2 people at home, etc. Laundry is cut in half, all those kinds of things. So the cash needs approach allows us to figure out what's the gap, what's the shortfall, and we try and buy insurance just for that gap, because a good portion of that person's income can go with them and help pick up a share of cost. Not all of it, but a share. And we figure that out so the well spouse is good. Everything's well for them. But we also figure out how much can go, and therefore you reduce the amount of long-term care coverage that you're buying, which makes it more affordable.
And when you talk about the well spouse there, husbands will come in and say, well, I just want my wife taken care of. I want her taken care of, so cover her, whatever she needs to be covered on. And in essence, they're not really helping their spouse by covering them. They're helping themselves.
Well, they are to some degree. The reason I'm grinning at you as you paint that picture, so to speak, is because 47% of the time it's the woman who's taking care of the man. And actually, I think that statistic is larger than that. I can't recall the exact statistic, but the majority of time, it's the female taking care of the male. So it's interesting that a husband, I understand the impetus to want to say, I want to take care of my spouse because we're wired to do that, and we've done that all our lives, our married lives, for example. But interestingly, if you only insure one spouse, you better be right. You're taking a 50% bet on which one's going to need the coverage.
In the big picture, it makes sense to do both. I mean, and really, more than anything, you're buying peace of mind.
Absolutely. Peace of mind is really what financial planning is all about. It's what we call freedom from worry about money. So if you apply that, for example, to retirement planning, there's no magic number where I'm looking for, and I'll think, as soon as I hit that number, I can retire. Everybody's number A would be different, and nobody really knows exactly what that number is. So we define it as simply freedom from worry about money. When I reach a point where I know I've got income coming in that I can rely on, it's regular and repetitive, and it's not at risk, and it covers all of my expenses, and there's an inflation adjustment to it as well, then I'm no longer worried about money. That's really the point where you can let your shoulders down, take a breath, and say, I can retire now if I want to. I'm covered. I'm good. But it has nothing to do with a specific number. It's a matter of, will my resources, my income flows cover my lifestyle and the contingencies that might happen?
Everybody has their status quo of how they want to live.
Sure.
So, somebody might live a little bit more extravagant than I do. I don't need much. I've got this and this. As long as I've got this, I'm happy. Yeah. But the main thing that you want to be able to take care of is the medical bills, because that's what can devastate people, right?
Absolutely.
And that's where, that planning really comes in. So what would be 3 things that you would tell somebody coming in for the first time?
Well, first, I would tell them that unless they're going to engage in holistic planning, which looks at every aspect of their financial well-being, including estate planning, that they're wasting their time. You cannot do this in today's complicated world on a piecemeal fashion or in a piecemeal fashion. You have to look at the entirety of a client's finances, resources, jointly, separately, etc., and how it impacts their tax situation, their estate planning, their inheritance plans for children and grandchildren. All those things have to be taken into account. That's number one. Number two, I would tell them that the biggest risk, without any question whatsoever, is the healthcare long-term care risk. We are clearly living longer and longer life expectancies. I have a mother who's 96.
Wow.
And still going strong. So we're living longer and longer lives, but we have no guarantee as to the quality of that life. Will I be the one who gets Alzheimer's or has Parkinson's or some other ailment that not only will curtail my life expectancy perhaps, but as you know, we can keep people alive a lot longer than we could 10 years ago, 15 years ago, because of the advancement in medical science. So the biggest risk is healthcare, long-term care. In fact, Fidelity did a study in 2018. It showed that the average married couple age 65 will spend $280,000 out of pocket, unreimbursed by insurance, between age 65 to end of life. Almost $300,000. So who has planned for that? And when I ask clients, have you planned for that? They sit and stare at me.
Do they look at you and say, well, what about Medicare? What about Medicaid?
Yeah, and Medicare will cover 12 cents on the dollar. I mean, it's ridiculous because Medicare doesn't cover long-term care at all. In fact, my mother recently had an incident where she got the 20 days of Medicare that they will cover, and then she either had to go to full self-pay or go home. And she went home, and we brought in 24-hour care for her. That's since terminated, but it was enormously expensive. So that would be the second thing, is you've got to build into your plan a contingency for the what if. What if there is a significant health issue that arises for one or both of us? How are we in the world ever going to cover that? And then third, I would tell them that you also have to enjoy life. So we build a plan that allows that couple, that individual, to take the trips that they want to take. but to do things in a prudent way where they know they have saved for it, planned for it, it's in the budget. It might be something that I want to go to France 3 years from now. We'll work on a plan to raise the money to do that so you can go worry-free and not feeling like you're spending your nest egg. So the nest egg needs to be there to cover your lifestyle, your income, adjusted for inflation for a very long time, and then there has to be those reserves or resources to cover the potential out-of-pocket medical expenses that we're all going to be exposed to. And beyond that, it's then how do we enjoy it along the way and not worry about all these things. So I will often say to my clients who want to go on cruises, next time you come in, I want to see either the pictures from the cruise or the tickets that you have purchased to go on the cruise.
You really seem like you enjoy what you do.
I love what I do. It's all about helping. I think financial planning and financial planners as a lot are people who are helpers. They want to help their clients realize their dreams and goals and objectives. And that's what gives me the juice is when I see clients getting what they want and happy and sharing the pictures with me. Some of them will email or text them from overseas somewhere. We're on our trip. Thought I'd send you this photo, and we just share it in the office and get a big kick out of it.
That's awesome. So it seems like you not only have to be good with the numbers, but you also have to be, kind of that counselor and good with the people too. There's more to advising financially than just knowing the numbers. You need to really, know the people. Well,
unquestionably. In fact, as you know, in our culture, money is one of the most intimate subjects because we don't typically even share with our family, siblings and our children what our finances are. So to have somebody come in and basically open the kimono and say, here's my entire financial world, I take that very seriously. It's a very privileged position to be in, and we honor it. And we tell people that this is not only confidential, but we will do everything we can to nurture this in the way that you want it nurtured. In fact, as you probably know, divorce is actually a higher cause for divorce than infidelity.
Really?
Finances. You can look it up.
I can see that.
Yeah, disagreements about finances. You got one spendthrift spouse and the other one's trying to save and invest, and they end up arguing about it, and it's a constant source of disagreement, and the next thing you know, they're heading different directions.
Yeah, it's funny that you say that. One of the things that my wife and I talk about is something we promised we would never fight about is money, because it's either there or it's not. We do what we can to make the money. We do what we pay what we can. And still try to have as much fun as possible.
Yeah.
So, what is your favorite part about being an advisor?
Well, I mentioned helping people. I think my favorite part is when, as we're going through the planning process, I can see on their faces and sense from them a fair degree of doubt of, are we actually going to be able to retire and live and let our shoulders down and take that breath and be comfortable and reach that point where we're free from worry about money. And then when we get to the end process and we've implemented the plan, it usually is a year, sometimes 2 years into the planning process. We're now doing reviews, minor changes or tweaks to things as things change that we talked about.
Right.
But I'll usually have somebody come back second, third year in and say, this is just wonderful. Now we know where we are. We've developed the habits. I'm not laying awake worrying about this stuff. There's a smile on their face and a lightness to them that wasn't there when they got started. And that's, I think, the most rewarding thing. And I can tell you individually what I most cherish from my clients. It's not the money I make. It's not the recognition or the accolades. It's the thank you notes that I have received from many clients over the years, saying simple things like, we're so grateful, we would never have envisioned this level of retirement had we not worked with you and your firm. Those are the things that speak to my heart and give me, as I mentioned earlier, the juice, the kudos, that to see, the jujus, as we like to say, that are rewarding, because those are experiences I don't forget. The money I couldn't tell you what I made 3 years ago. I'd have to go look it up. But I can find that card somebody sent me 3 years ago. I know right where it is, because those are experiences. So there's clearly an emotional component to all of this that I think you have to broach with clients. They have to not only trust their advisor, they have to like their advisor, clearly. And that advisor becomes a very intimate partner in their lives.